The financing rules change above $1 million that normally catches buyers off guard. And in a market where over 40% of the luxury transactions close in cash, understanding exactly how a financing buyer competes and what they can do to close the gap is information that directly impacts whether you get the property or not. In this video, we're going over the financing landscape for $1 million to $3 million buyers in Fort Lauderdale, what jumbo loans actually require, what the down payment really looks like at each price point, how cash buyers affect competitive situations, and the specific things a financed buyer can do to strengthen their position before they make an offer. My name is Steve McAleer. I've been selling real estate in Fort Lauderdale for 20 years, completed over 600 transactions in this market, and I work with The Agency, one of the premier luxury brokerages in the country. Financing is the dimension of the luxury buying process that most buyers from outside South Florida understand least well before they arrive, because the jumbo market operates by different rules than the conforming market, and those rules have direct consequences for how quickly you can move and how competitive your offer looks to a seller. Let me give you the real picture. The 2026 conforming loan limit sits at about $832,750 for most of the country. Jumbo loans operate differently from conforming loans because they're not eligible for purchase by Fannie Mae or Freddie Mac. Instead, jumbo loans are typically held by banks, sold into private secondary markets, or retained within portfolio lending programs. That means underwriting standards can vary significantly from one lender to another. There is no single uniform jumbo loan rulebook the way there is for a conforming financing loan. One jumbo program may require 20% down with 12 months of reserves. Another may require 25% down with 18 months of reserves. A private bank serving high net worth clients may evaluate complex income structures more flexibly and offer entirely different document standards. Shopping the jumbo market matters in a way that shopping the conforming market often does not. The documentation requirements for jumbo underwriting are more extensive than conforming. 2 years of tax returns is standard. And for buyers with business ownership, investment income, or complex income structures, the tax return picture may show income that looks different from the actual cash flow available to service the loan. Jumbo underwriters are accustomed to this complexity, but they need to see it documented appropriately. W-2 income is for the simplest profile. Self-employment income, partnership distributions, investment income, and bonus-heavy compensation structures each require specific documentation that takes time to assemble. Debt-to-income ratio standards for jumbo loans are often more conservative than conforming financing. While some conforming programs may permit DTI ratios above 45% with compensating factors, many jumbo lenders prefer ratios closer to 43% or below, depending on the borrower's overall financial profile, liquidity, and reserves. Existing obligations, including other mortgages, business debt, vehicle financing, and personal loans, can materially affect borrowing capacity even for high-income buyers. Reserve requirements are often the jumbo loan underwriting standard that surprises buyers the most. Many jumbo programs require borrowers to demonstrate liquid post-closing reserves equal to 6 to 18 months of the total monthly housing payment, and sometimes more for larger loan amounts or condominium purchases. On a luxury purchase with a substantial jumbo loan, that can translate into well over 6 figures of documented post-closing liquidity. Retirement accounts may count subject to a reduction factor, while brokerage and investment counts are generally viewed more favorably. The assets must be documented properly, seasoned appropriately, and structured in a way that satisfies the lender's underwriting guidelines. The down payment landscape in Fort Lauderdale's luxury market differs based on the price point and the lender's program. At the $900,000 to $1.2 million range, effectively the entry level of Fort Lauderdale's luxury market and one of the most common price points for buyers utilizing jumbo financing, many programs require a minimum of 20% down. On a $1 million purchase, that equates to $200,000. Some lenders offer 10 to 15% down payment programs for exceptionally strong borrower profiles, though these structures often involve higher interest rates, stricter reserve requirements, or mortgage interest components that materially affect the overall economics of the loan. For many buyers in that range, planning for 20% down plus closing costs is the practical baseline. At the $1.2 to $2 million range, 20% to 25% down becomes increasingly common across jumbo lending programs. As loan balances increase, many lenders seek additional borrower liquidity to reduce exposure. On a $1.8 million purchase, a 25% down payment represents $450,000. $150,000. Combined with estimated closing costs of approximately 2%, which is roughly $36,000, the buyer may need nearly $500,000 in liquid funds for the transaction itself, separate from any reserve requirements imposed by the lender. At the $2 million to $3 million range and above, some lenders may require 30% down, particularly for second homes, investment properties, condominium purchases, or buyers with complex income documentation. Private banks and wealth management affiliated lending platforms may offer more flexible structures for high net worth borrowers with substantial liquidity and asset positions, even when income documentation is less conventional. Accessing these programs is often easier when the buyer has an existing banking relationship or is introduced through an experienced real estate or financial professional familiar with luxury lending channels. The strategic dimension of the down payment percentage is this. In competitive offer situations, a larger down payment signals financial strength to the seller and reduces the seller's concern about financing contingency risk. A buyer putting 30% or 35% down with a 10-day financing contingency represents a meaningfully different risk profile to a seller than a buyer putting 20% down with a 21-day financing contingency, even at the same purchase price. In a situation where a seller is choosing between multiple offers, the financing structure of the offer is evaluated alongside the price. Let me give you the honest picture of the cash buyer's dynamic in today's luxury market. Cash transactions represent a significant share of luxury closings in Fort Lauderdale. In some neighborhoods and price ranges, the majority of transactions, in fact. Buyers coming from the sale of a primary residence in Greenwich or Westchester or the North Shore of Chicago are frequently deploying equity rather than financing. Buyers doing 1031 exchanges from investment property sales arrive with identified replacement funds. International buyers who are moving capital to the US frequently transact in cash. The result is a buyer pool in the $1.5 million and above range where your financed offer is competing against cash offers with real frequency. What a cash offer gives the seller that a financed offer does not is certainty and speed. A cash offer has no financing contingency. The deal does not fall apart because an appraisal came in low or because underwriting surfaced an issue in the final days before closing. A cash closing can happen as early as 2 to 3 weeks rather than 45 to 60 days. For a seller who has already identified their next home, who is on a timeline, or who has had a prior deal fall apart over financing, the certainty premium of a cash offer is real, and sellers price it accordingly. The practical implication for finance buyers is not that you can't compete, it's just that you need to eliminate as much of the uncertainty differential as possible. Fully underwritten pre-approval, where the underwriter has reviewed your complete file and issued a conditional approval before you make an offer, is the most powerful step a financed buyer can take to narrow the gap with a cash offer. This is different from a standard pre-approval letter, which reflects an initial review of your application. Full underwriting means the lender has done the work and the remaining conditions are manageable items like title insurance and a property appraisal. A shorter financing contingency period also signals strength. A financed buyer with full underwriting in hand can credibly offer a 10 to 14-day financing contingency rather than the standard 21 days, which closes the timeline gap with a cash offer meaningfully and signals to the seller that the financing risk is genuinely low. And by the way, if you are looking to purchase a home here in Fort Lauderdale, I've put together a great resource for you. It's called the Fort Lauderdale Home Buyer Guide. Inside, you're going to find information on every neighborhood, every price point, what to buy, what to consider, and how to move here without second-guessing yourself. It's totally free. The link is in the description. The appraisal is the stage of a luxury financing contract that can cause the most amount of friction. And this process is super important to understand before you're under contract and encountering it for the first time. Lenders require an independent appraisal on any financed transaction. The appraiser's job is to determine whether the property's market value supports the purchase price. If the appraisal comes in below the purchase price, the lender will only finance based on the appraised value, which means the buyer must either make up the difference in cash, renegotiate the purchase price with the seller, or exercise the appraisal contingency to exit the contract. The challenge in Fort Lauderdale's luxury market is that truly comparable sales can be limited with highly specific micro markets. In neighborhoods such as Las Olas Isles, no two waterfront properties are identical. Canal width, water depth, lot orientation, bridge clearance, dockage capacity, and proximity to the intracoastal all materially affect value, sometimes dramatically, even between nearby parcels. An appraiser without meaningful experience in Fort Lauderdale's waterfront market can undervalue characteristics that local buyers and sellers sellers recognize as highly significant, creating an appraisal gap that becomes a transaction issue later in the process. There are practical ways to manage appraisal risk in a financed waterfront purchase. First, work with a lender experienced in luxury waterfront financing and familiar with appraisers who regularly evaluate high-end coastal properties in Fort Lauderdale. Second, your agent should prepare a detailed comparable sales package highlighting relevant recent transactions and documenting the specific waterfront characteristics that support the purchase price. While appraisers make independent determinations of value, strong supporting market data can materially help frame the analysis appropriately. Finally, if an appraisal does come in below contract price, it should be viewed as a negotiation event rather than automatically a failed transaction. Many experienced sellers in the luxury market understand the limitations of waterfront appraisals and are willing to discuss price adjustments, buyer cash contributions, or other solutions to bridge the gap when both parties want the transaction to close. Who you use as your lender in the Fort Lauderdale luxury market matters more than you think. The lender categories worth evaluating for a Fort Lauderdale luxury purchase are meaningfully different from what most buyers have worked with before. National retail banks, the major institutions with consumer mortgage divisions, they have jumbo programs, but often at rates and terms that are less competitive than alternatives for high net worth borrowers. Private banks and wealth management affiliated lenders, institutions that serve clients with significant investment assets, often offer better jumbo terms to clients who bring a banking or investment management relationship alongside the mortgage. Portfolio lenders, which are institutions that hold their loans rather than selling them, can offer flexibility on documentation requirements for borrowers with complex income structures that conventional underwriters handle poorly. The practical approach to lender selection is to obtain competing quotes from multiple lenders before committing to a financing program. For buyers with substantial assets or an existing banking relationship, including at least one private bank or wealth management affiliated lender in that comparison can be worthwhile. On a jumbo loan program, even modest differences in rate structure, reserve requirements, or underwriting flexibility can have a meaningful financial impact. There are also several practical steps financed buyers can take to strengthen their position before entering competitive negotiations. Completing a fully underwritten pre-approval before actively making offers can significantly reduce financing uncertainty. Increasing the down payment percentage when financially appropriate may strengthen the overall perception of the offer. Shortening the financing contingency timeline based on the lender's actual underwriting capacity, rather than using unnecessarily conservative timeframes, can also improve competitiveness in multiple offer situations. The financed buyers who compete most effectively in Fort Lauderdale's luxury market are typically the ones who reduce uncertainty before the negotiation begins. Cash offers create confidence through certainty and speed. A well-prepared financed buyer can narrow the gap substantially through strong underwriting preparation, strategic offer structure, and a lender capable of executing efficiently in the luxury market. And that takes us to the end of this video. If you're looking to buy a property here in Fort Lauderdale, I'd love to assist you. All of my contact details are below.